In the previous lecture video, we had identified 5 key economic indicators, and in this video we will examine income of a country. And income of a country is usually measured through a concept called GDP, and that's what we look at now. One of the measures of income of a country is GDP-MP, and GDP-MP stands for Gross Domestic Product at Market Prices. And here is the formal definition, and that is GDP-MP is the market value of all final goods and services produced in an economy over a period of time, usually a year. And here I've highlighted parts of the definition which will require some explanation. So let us look at the easier part first. Now, this is the amount of goods and services produced in an economy, and we'll be looking at it from a country's perspective, and in here it will be the US. Now, GDP figures or GDP-MP is measured on a monthly basis, quarterly basis, as well as annual basis. And if you look around, for most of the countries, this data is available on an annual basis. Gross domestic product at market price, GDP-MP. Now, market value is the same thing as market price, and market price is a sum of factor cost and indirect taxes. What do we mean by factor cost? Factor cost is the cost of producing and selling a good. Consider the following example. You go to a store like Walmart and you want to purchase a bottle of shampoo which is listed at a price of $6.99. But that's not the price you pay. You pay $6.99, the cost of the shampoo, plus taxes on that, namely sales tax. So the market price for you is factor cost plus the tax that you pay on that good. And the tax that you pay on that good is called indirect taxes. And what is factor cost? Factor cost is simply the cost of producing and selling a good. And so when we are looking at GDP-MP, we are looking at market price. And remember this relationship, market price equals factor cost plus indirect taxes. In an economy, there are two types of taxes. One called direct taxes, and these taxes are levied on income and wealth side. Examples of this are the personal income tax that you and I pay, or corporate tax that is paid by businesses, and if you're rich, you also pay a wealth tax. So direct taxes are taxes that are levied on income and wealth. And this has to be distinguished from indirect tax, something I alluded to on the previous slide. And these taxes are levied on expenditure side. An example of this is sales tax, customs duty, the tax we pay on imports, excise duty, and this is imposed on liquor and things like that. So direct taxes and indirect taxes, and taxes is the money we pay to the government. Taxes have to be distinguished from subsidies. Subsidies in a way can be considered negative taxes, and that is, instead of paying money to the government, you receive money from the government, and this could be given by the government to producers or businesses as well as to consumers. GDP is a measurement of final goods and services that are produced in an economy. So what does a final good or a service means? This simply means that this good or service is finally consumed and is not used as an input into production of something else, this final good or service has to be compared with intermediate good or service. An intermediate good or service is one that is used as an input into production of something else. To give you an example, suppose I buy steel and I just leave it in my backyard. In such a case, steel that is purchased by me will be considered a final good. If the same steel is bought by a car manufacturer and used for producing cars, in such a case, steel will be considered an intermediate good. So what is an intermediate or a final good depends on where it is destined to be. Is it being used as an input into something else, or is it being finally consumed by people like you and I, consumers? To understand why we use final good or service into calculation of GDP and not intermediate good or service is to avoid a problem we call double counting. Now, as far as production goes, just remember it happens in stages. And look at a very simple example of bread that we eat. Suppose it costs nothing to the farmer to produce wheat, and farmer sells his output to the miller, who converts it into flour for $50. So what is the contribution of the farmer to the production of wheat? It will be $50. Now the miller receives wheat, converts it into flour, and the miller sells the flour to the baker for $80. So what is the contribution of the miller to this production of this output called flour? It will be 80 minus 50, and that will be $30. Now the baker receives the flour from the miller for $80. Then baker bakes the bread and sells it to people like you and me for $100. So what is the contribution of the baker to production of bread? It will be 100 minus 80, and that will be $20. So at every stage of production, every agent adds to the value of the product. And what is value added? Value added is simply the difference between sale price and the cost of inputs. For example, when the miller sells flour to the baker for $80, what is the sale price? It is $80. But what is the cost of input to the baker? It is 50. And so 80 minus 50 is the value added by miller. What is the value added by baker? It is $20. And if you add up all the value added, what you'll get is $100. And this is the same thing as the price we have paid for bread as final consumers. So remember another rule: market price is a sum of value added. So why do we, if we look at just final good or service, and if we also want to include intermediate goods and services, that means we are double or multiple counting. So when we are looking at GDP, what we look at are final goods and services and not all sales that are taking place within the economy. Now let us look at what is excluded from GDP calculations. The first thing is GDP is compiled by the government, and what it is looking at are legal activities. So all illegal activities that take place are not a part of GDP. For example, trading in drugs, smuggling, and so on. So all illegal activities are excluded from GDP calculation. And in GDP, since we are looking at all market transactions, non-market transactions are also excluded from GDP, though they contribute to the output. For example, if you take your dirty laundry to a laundromat and you pay money for use of machines, in such a case, this transaction will be entered into GDP calculations. But if on the other hand, you take this dirty clothing and your mother uses her washer and dryer at home, then this becomes a non-market transaction and is excluded from GDP. Another example is when you buy food from outside, it's a part of GDP. When you cook food at home, it's not a part of GDP. So non-market transactions are also excluded. The third part which is excluded is transfer payments. In GDP, what we are trying to include are productive activities or money transactions which involve creation of goods and services. Transfer payments are those payments which do not result in creation of a good or service. For example, if you receive a gift check from your grandmother on your birthday, that's not a part of GDP because she has given it to you without expecting any production of good or service. Similarly, welfare payments that are received by poor people is also an example of transfer payment. Why? Because they receive it without really creating any good or service. So transfer payments are also excluded from GDP calculations. Like we looked at the case of intermediate goods, similarly used goods are also not a part of GDP. For example, if a car was produced in 1989 and someone bought it in 1989 and it gets sold in 2017 as a used vehicle, the value of that car has already been included in the GDP in 1989, and so it should not be a part of GDP in 2017. Similarly, trading in stocks is also not a part of GDP because we believe stocks is just a financial transaction and it does not lead to a creation of any good or service, and hence it is excluded. And then we have also looked at the case of intermediate goods and services. So this is an exhaustive list of all things that are excluded from GDP. And this concludes this lecture. Thank you for your time.